Hey, how's everyone doing out there? Can you give me a heads up? Let me know if the audio's coming in okay for you guys. Thanks a lot. Appreciate it. Babar, how you doing? One Royal Wolf, the Mick, how you doing? Aloha, always be funding. Jack Parsons, how you doing? Sean McDonald, Seaboard Rivers, Max Strong, Bonzo 22, how y'all doing? So we'll be starting in just a minute. Samari, how you doing? Silver Warrior. Okay, so we got a few more things in order, and we'll get started with this. Hello again, everyone. Welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vera, and this is our live stream. Glad you all could make it. Whether it's Monday morning here in Asia, late in the evening, or early in the morning in Europe, or at night in the States, appreciate you guys being here. If you are new to this channel, go ahead and type in "new" and where you're from, and we'll see if we can acknowledge you up in the live stream. So again, we thank you all for being here, and we appreciate that quite a bit. So again, if you are new to this channel, please do subscribe, hit the bell to be notified on updates, and give us a thumbs up. If you like what we do, we really do appreciate the support. Thumbs up. They mean a great deal for us. And you can always find us on social media. We're at silverbullion.com.sg. It's our website where we do specialize in systemic wealth protection. Once again, if you truly know what's going on in this world, you do know that we are headed for some very incredible things that are going to be happening, but some incredible opportunities that are going to be there as well. And this is what we specialize in, helping you to find these opportunities and be prepared for them. Silver Bullion SG is our Facebook handle. You can find us on Twitter at Silver Bullion PL for private limited. The two audio versions you can find us are on bit.ly, bit.ly, SBTV iTunes, SBTV Spotify, and you can go ahead and join our crisis tracker group. This is probably one of the better things that you can do. If you have the Telegram app, or even if you don't, go ahead and download it. It's a free group, Telegram group, where we post news as it pertains to gold, silver, finance, economics, things like that. So it's a good way to stay abreast of what's going on, because there is a lot going on. So again, just want to take a quick roll call here. Sumari, how you doing? Gone fishing, like the music. Thanks, appreciate it. It's always a mission to try and find something. Lieutenant Colonel Rod Brumley, how you doing, sir? Silver, let me see what you got there. Silver was up 27 cents and now down 28 cents. Volatility as always. That is true. That is true. Never ending. Rod Brumley. Okay. Hang on a bit. Okay, so let me see what else is out there. Bonzo 22, how you doing? Silver Warrior. Let's see. Yeah, that is a good question. Silver Warrior. How many people on here store metals in Singapore? That is a very good question. I'm kind of curious as to that myself. So it would be interesting to see the answer for that one. Got a little bit of a new format here, so I'm just trying to kind of get accustomed to it. So just bear with me for a little bit. Ron Lipper, how are you doing? Um, Gipsy, wash hands. Okay. Bob Pines, new from Montreal. Welcome aboard. Glad you could make it here. Polynesian Pip, how you doing? Matt Marlowe, here in Lexington, Kentucky. Glad you could make it, Matt. Appreciate you coming out and supporting us as well. Let me see what else is out here. Um, okay. Let's see. Gnarly Silver. I gave a thumbs up for just not being annoyed by your live stream countdown. Okay, so there's another opinion. Everybody's got opinions, right? So one guy likes it, one guy doesn't. So fair enough. Fair enough. Fair enough. Tomorrow, Tennessee, how you doing? Glad you could make it out here. Okay, so I guess we'll go ahead and we'll get started with the program here. As you know, um, we do a weekly interview where we try and get some of the better names, not better. We try and get who we can, who we may think you'll be interested in. And so our upcoming guest this week, some guy Timothy Maxwell Kaiser. I heard he's pretty popular, so we're going to bring him on. Markets finance scandal. Max Kaiser of the Kaiser Report brings his no holds barred look at Bitcoin and the shocking scandals behind the global financial headlines, from the collusion between Wall Street and Capitol Hill to the latest banking crime wave, from bogus government economic statistics to rigged stock markets. Nothing escapes the eye of Max Kaiser. So we'll be bringing him on. He'll be our interview for this week. And let's just hope there's no technical difficulties. You just never know. These things just pop up from time to time. So moving on, we are going to play our thank you ebook giveaway. We're going to be giving away The Creature from Jekyll Island one more time. Seems to be a interest in this book, especially after our interview with G. Edward Griffin. So we decided to bring this book back. It's a classic expose of the Fed that has become one of the best-selling books in its category of all time. Where does money come from? Where does it go? Who makes it? The money magician's secrets are unveiled. And here's a close look at the mirrors and smoke machines, the pulleys, the cogs and wheels that create the grand illusion called money. So we're going to be giving away his ebook as a thank you. So house rules: download the Kindle app from your phone or tablet's app store. It's free to do. Be the first to answer correctly in this live stream before the time runs out. U.S. winners will be given a link to download the ebook. Winners outside the U.S. will be offered an alternative prize at our discretion. And you're going to have to provide us an email during this live stream. But what we'll do is we'll mute your comments so no one else can see it except us. And then we'll go ahead and get your email address from there. Okay, so we're going to be asking that question soon. So hopefully folks watched last week's interview because that's where it's going to come from. So having said that, here we go. Here's the question. Last week, Steve St. Angelo said you have to have blank growth to pull you out of a recession, depression. So what type of growth was Steve St. Angelo referring to? Okay, so the answer comes from last week's interview, and we're going to see who can get it. And then we'll go ahead and send them the ebook, Creature from Jekyll Island. So let me take a look at the comments here, see what's going on. Okay, Steve St. Angelo said you have to have blank growth to pull you out of a recession, depression. Okay, so I see some answers coming in. Let me see. Okay, good answers coming in. One of them is actually right, but keep going. Okay, some good answers here. Okay, looks like two guys got it right so far. Okay, so Steve St. Angelo said, what is the growth that you need? The answer is energy. Energy is what you need. So let me take a look at this. I think Paul Bar was the first one that had it right. Let me go ahead and confirm that. Let's see. Hang on, just want to check, make sure it was Paul Bar who got it first. Okay, so we'll go through it a bit later. Hang on, I need to I need to get this right. Okay, Paul Bar, you got it right first. Energy, so you're gonna be winning the book. Okay, so we'll get your email later. One Royal Wolf, you also said energy. Who else said energy before that clock ran out? I think there was one or two more. Hang on, let me check here real quick. Okay. Xiao Xiong Ching, you got it right also. I think you were the three that got it right. Okay, so we're going to have to get all your email addresses, and I'm going to have my colleague Vincent. He'll be messaging you guys, and the reason for that is because, well, first of all, let's make sure energy is the right word.
You have to have energy growth to pull you out of a recession depression.
Okay, so the word is energy, and surprise. The reason why we wanted a few more names was because we're going to give the runners up the Build Your Own Bank ebook as well. And that's going to be going to one Royal Wolf. And let me get that name again. Xiao Xiong Ching. You're going to be getting that ebook as well. So those were the two runners up. Let me just write this down real quick. Okay, so there we go. Sorry about that. Had to get that ready. Okay, we're back again. So let me see what you guys are talking about right now. Um, I noticed you folks were, yeah, quite a bit to say. You folks were talking about quite a bit of things. So I just want to jump in and see if there's anything that we can add on. Um, okay, let's see. Okay, okay, right. Rolf Steiner, yeah, true. Let me see. Let's see. Okay, all right. I guess you guys are doing fine. So let me move on. We're going to take a look at our website, check out the gold price, and we're going to move on to Twitter, check out a few things there, and then I'll revisit Steve St. Angelo, go back and look at a few things he said, and then we'll go ahead and take a look at a few things Jay Powell said. So we got quite a bit. So let's just go ahead and start getting through them all. So first one, let me refresh this. We'll go ahead and take a look at the silver price, gold price. So right now we're at let's see, silver 2506. It was up a bit more. It's come down somewhat. Gold has come down a little as well at 1925 per ounce. Silver at 2506 per ounce. And let's see, that silver to gold ratio should have gone down a bit. Yeah, 76.8. So it's coming back down after visiting the 80 level. It's on its way back down. Investor kit here, do download it. It's a free investor kit. So just simply click on it and you're going to get the PDF. Um, it's all right here for you. A few good things, actually a lot of good things. The buying process, applying for a storage account, having that storage account, it's a pretty good deal to do. It is free. There are no maintenance fees to it. Borrowing or lending with the secured peer-to-peer program, peer-to-peer loans. This is if you do store gold and silver with us, you can actually borrow against it. You still own it. You still own it. You can borrow against what you own, and you can go ahead and buy more silver, buy more gold. That's what you wish to do. So again, you can sign up. It's here. It's free to do. So we hope you do go ahead and take advantage of that. There are no maintenance fees for it. So Twitter, let's move over to Twitter. A few things that are bookmarked here. GNS Economics. This is kind of interesting here. Buildup of risk in low interest rate environment that preceded the current recession likely will make economic recovery from the pandemic more difficult. And this is pretty interesting because it comes from the Fed's Rosengren. So this is what he had to say. Years of low interest rates made the current economic crisis worse. So a bit of maybe they're having second thoughts here about what they did all of these past years. So Boston Fed President Eric Rosengren said years of low interest rates that encourage risk taking are making the current economic downturn worse. He specifically cited low rates persisting for an extended period, even after the economy had made progress in the recovery, and it can create problems. So those were the key points with what he said. Um, there is a video here with Lloyd from Lloyd Blankfein, the ex Goldman Sachs CEO. So he has some interesting things to say as well. I'll go ahead and play this.
I think in terms of risk management, and I'm not just being nice, but obviously that was one of the things that you were great at. And I think, as a trader, I think that, that's why you ended up running Goldman Sachs. So if you're running this country in terms of fiscal and monetary policy right now, are there risk red flags coming up to you yet? If we're 100 and I don't know what we are as a percentage of GDP in terms of debt, but other places have gotten into trouble at similar levels in the past.
Well, sure. Not just the level of debt, the level of interest rates. Money is close to a free commodity, and when something is free, you tend not to husband it, and you tend to overuse it because like it's a free good, and so you have to be very, very cagey and alert because you know that even if you can't see them, they'll be perfectly obvious to you in hindsight. And obviously people will remember, your critics will remember having seen it and that you should have seen it, but people aren't seeing it. But you know that given that money is kind of free, it presumably is not being allocated in a disciplined way. And so there are bubble elements to this, and you can see them, you could see some things, obviously the credit market, people are lending to, what historically would have been viewed as weak credits for very, very little money. Look, people are lending to the U.S. Treasury for today 80 basis points, but for a long time 60 basis points for 10 years, as if there would never be inflation again, as if the dollars you're going to get back plus 60 basis points a year is going to compensate you for the risk you're taking. So the wash of money is clearly creating bubble elements. You look at SPACs and how much money is available on the basis of somebody's reputation, for example, as opposed to a business plan.
Okay, so that was the ex Goldman Sachs CEO. Hang on, let me see if I can figure out what's going on with that sound as well. Hang on, let me see if I can take care of that. Okay, all right. Hopefully, sorry about that. Okay, so anyway, so that was Lloyd Blankfein, ex-CEO. Sorry about that, guys. Okay, so moving down, Max Kaiser, the last gathering of authoritarian bankers before Bitcoin overtakes them by this time this year. Yeah, that's a pretty interesting picture to look at. Two Fed heads now, one from the ECB and of course the Federal Reserve. William Middlecoop, he tweets out, the WHO, stop using lockdowns as your primary control method of the virus. That's pretty interesting because we're still seeing people going back and forth. I guess it's a progression. Guys they did what they thought was right, and maybe they figured out maybe it's not the best thing, or they're still trying to figure it out. They really are still trying to figure it out. So now they're saying, the WHO is saying lockdowns as your primary control method. It's may not be the best thing. So that was pretty interesting coming from them now. Ben Rickert, the Banking for All Act, and we've talked about this as well. Digital dollars, digital dollar wallets, the ability for the Federal Reserve to now control the velocity of money by creating an ephemeral nature to the dollars held within these accounts that would decay faster if not spent. And that is true because if you only have digital and you can't pull it out, you can't pull cash out, and you just have that digital in your bank account, and let's say things go negative or they take rates negative, you're going to lose money if you keep it in that account. You're going to be forced to spend it. And this is partly in why he's saying that would decay faster if not spent. Once we're completely digital, no cash, the Fed can really get the monetary policy they want, and the government can really get the fiscal policies that they want. SRS Rocco reports, update, if this Fed digital dollar policy gets passed, then we are talking about a transition from asset price inflation to consumer price inflation. And that's without a doubt, we are going to see that. Daniel DiMartino Booth, the fact that so many large landlords have continued to file evictions is both surprising and disappointing, given that the CDC put in place the moratorium to limit the spread of the bug. The reason why I threw this in was just to show that there is so much uncertainty right now, so much instability going on, and it doesn't look like it's going to ease up anytime soon. In fact, it does look like things may get a bit more pronounced. And again, these are all the reasons why we do what we do, and we understand that we should be moving into assets outside of the monetary financial system, things like gold and silver, and perhaps getting away from the US dollar. And in fact, this is one of these stories here where, it's just put out over the weekend that Iran dumps the dollar for Chinese yuan. And this is just a start. We're going to see more and more countries moving off the US dollar. So adoption of the Chinese RMB as foreign reserve currency seen as the latest move to bypass US sanctions and revive oil sales. So what you've been hearing people talking about, as well as us for some time, you are now seeing it, where this is one domino to fall right here. And there are going to be more dominoes that are going to fall as well. I think Argentina is looking at doing the same thing. So here we go. They're starting to move off the dollar. So according to reports in China and Iranian state TV, the Central Bank of Iran has announced numerous changes, including that it now lists the yuan as the country's main foreign exchange currency in place of the US dollar. So it's pretty big news that's so far pretty quiet. Front running the Fed announced what they were going to do, and of course there were people who jumped on it and moved ahead, and they've done pretty well. SRS Rocco again report stunning amount of precious metals ETF demand, although silver is the clear winner. So guys are still pushing ETFs. Let me see. This one was pretty interesting as well. Stanley Druckenmiller says the stock market is in an absolute raging mania, and I think most of us know here there is a disconnect between what's going on in the markets and the true, real economy. So some key points. Everybody loves a party, but inevitably after a big party, there's a hangover. Right now, we're in an absolute raging mania. Raging. We've got commentators encouraging companies to do stock splits. Companies then go up 50, 30, 40% on stock splits. That brings no value, but the stocks go up. So this is what he had to say. All right, so we'll just kind of get through this part here. They always have their advertisements in the beginning, but what he said was pretty interesting. It is a type of a raging mania, and again, we are seeing the markets disconnect. The stock markets are disconnecting from the true, real economy. And Druckenmiller, he points this out. So we'll go ahead and listen to what he had to say here.
I think the merging of the Fed and the Treasury, which is effectively what's happening during COVID, sets a precedent that, well, we've never seen since the Fed got their independence. And it's obviously creating a massive raging mania in financial assets. And as you just pointed out, Joe, it has not spilled over to Main Street. I would just say that I hear a lot of people on the air applauding Jay Powell, saying he saved the world. And I do think he did a great job in March. I think the follow-up's been excessive. And I just want all you guys cheering him on to remember the maestro in 2005 and how that worked out. Look, everybody loves a party. Jeff loves a party. Mommy loves a party. I love a party. I assume you guys love a party. But inevitably, after a big party, there's a hangover. And right now, we're in an absolute raging mania. We've got commentators on your network encouraging companies to do stock splits. Companies then go up 50%, 30, 40%, big market cap companies on stock splits. As Andrew pointed out early in your show today, that creates no value, but the stocks go up. Look, Joe, I have no clue where the market's going to go in the near term. I don't know whether it's going to go up 10%. I don't know whether it's going to go down 10%. But I just want to remind people that there is no valuation support because we dropped 10%. That hasn't mattered because we're so far outside of the valuation realm with the Fed doing what they're doing. That doesn't matter. But I would say that the next 3 to 5 years is going to be very, very challenging.
Right. Very, very challenging. So, hey, buckle up, gang. We're going to be in for a wild ride here. And there was one more clip from CNBC that I wanted to show you. As long-term Treasury yields rise, investor Peter Lokbar warns inflation would spark the market's worst nightmare. So we'll go ahead and we'll take a look at what this gentleman had to say as well. I think we may have to deal with that intro again. So let's just kind of bear with it. All right, so let me just turn that down for a bit, and I'll get to the comments after this. See what's going on, what you folks are having to say right now. Human K-shaped recovery. That is true. We're hearing that word more and more now. K-shaped recovery. Okay, so here we go.
Inflation will mean for the markets and the economy. Still, while there's signs that it could potentially rise, how high does it have to get before we really start taking it seriously?
Well, I think we're about to see next week a core CPI number that could be 1.7%. And while that is sounding still low, it's the monthly trajectory that we've seen that I think is building up to something greater. And I think once you start getting above 2%, particularly in the PCE, which is the Fed's metric that they watch, higher inflation becomes potentially dangerous, because I think it's going to come with still very mediocre economic growth. So that sort of stagflationary type combination could handcuff the ability of the Fed to do more easing, lead to higher interest rates, which would crimp a very credit-dependent economy, and can also hurt, as I mentioned, those high PE stocks. So in a way, a stagflationary type of environment, if it were to happen, is the market's worst nightmare, I believe.
Okay, another interesting point you had to say there. I don't know about you, but I'm seeing more and more guys coming out, and they are talking about the concerns of inflation. So, it is starting to pick up. And with what Druckenmiller had to say, I think people are starting to see that inflation coming out of the markets and starting to trickle over into Main Street. I think it is starting to show there. Katusa Research, Marion Katusa, I still believe that gold hasn't even started its first inning in the big leagues. This will be hard for most to fathom, considering we have had such large runs in many of our gold equities. Okay, so that's a look at Twitter. I think we spent enough time there. Let me take a look at a few comments, and then I want to move over into some things that Steve St. Angelo said. Let's see a few comments here. Seymour Rivers, going to have to weed out fake bullion, fake watches, too much fake stuff. Be careful. That's a good point. I think as we see gold and silver rise, I think you are going to see more fakes coming into the market, and we are going to have to know how to test them. We're going to have to definitely know what to do, what to look for, and we're seeing mints coming out with even more advanced security features. I think you're going to see some from the Royal Mint with their new Britannias. They have, I think, 2 or 3 different types of security features that are going to be on the new 2021 Silver Britannia. So good for the Royal Mint. So we're going to see more and more security features that are going to be added that are going to be difficult for counterfeiters to go ahead and replicate. So moving on, I want to go ahead and take a look at something that Steve St. Angelo said, a few things. So after speaking with him, again, I want to revisit a few things that were pretty interesting, and I hope you'll find them interesting as well. Steve St. Angelo.
I think when we look at the charts and you look at silver, the big number for silver is 35. That 35 is the big number. Even though 30 is a level, once it gets above 35, there's nothing until it goes up to the 40s, high 40s.
Okay, so we're looking for that $35 chart, $35 level. Charts are showing that to be a big number for silver. So it's a critical number for silver. And if you watched our quick take on short-term silver with Chris Vermeulen last week, Chris also said 35. This is a series where we're going to be starting up, and we're going to try and give you more quick info on the things you need to know. So Chris, he talked about price action of silver, and this is what he had to say as well.
We could see silver and metals and miners in general rally going into the year end. I think there's going to be uncertainty with elections. There's going to be more stimulus. To me, that's bullish on metals. It's lots of uncertainty. So I think we could see silver, once it finds a bottom here, run up. And I think we could hit that $34, $36 resistance area. That might be the max out for this year. That would be a pretty nice run. I mean, we're only 2.5 months away from the end of the year. But that's about the time frame. The chart pattern that's there takes us pretty much to the end of December for that 34, 36 target. After that, I think January is going to be one heck of a wild kind of reset, a new year. Who knows what's going to happen? I think it's going to have some pretty big volatility. I don't know which way the markets are going to go at that point.
Okay, so that was Chris from Bullion. He's also looking at about that $35 level would be about the max according to charts for 2020 this year. If you watch that short interview with Chris, he did mention that we may be looking at perhaps even $80 silver in H2 of next year, 2021. But Steve, in our interview, he said something that was pleasantly similar. If you're on the fence about getting into metals, if you are on the fence, go ahead and listen to what Steve St. Angelo had to say.
Gold and silver are not just commodities, they're money, because most of the gold that's ever been mined since the last 500 years is still with us. So it performs as money, a store of value. And now, as more investors are waking up and moving into the metals, it's going to pull the price up. And so I think this next market, this next bull market, is going to be much different. And I actually look at it as a bull market that won't end. Why? Because the energy situation is going to destroy the value of most stocks, bonds, and real estate. And that's not going to happen in a year or two. That's going to be an ongoing multi-decade, probably 5, 10, 15 years. And so the only way to protect your wealth as those assets are falling is in the metals. So to me, it's not where, okay, the price of gold is going to go to 3,500. I got to sell and get my dollars. What the heck are you going to do with your dollars? You only sell the metals in the future if you need to purchase something, not because, or you could sell gold for silver or silver for gold. But you're not going to sell because, oh, I got a high price and I'm going to go back into fiat currency. That would be very stupid because currencies are going to get into more trouble with the energy. So that's how I see this next bull market. It's a bull market that I don't think it's going to end. It's going to fluctuate, but I don't think the metals are just going to get stronger and stronger to own as Americans and citizens throughout the world understand the dire energy situation that we're facing. It just makes sense to own the metals in the future.
Okay, so it makes sense to own metals in the future. It makes sense to own metals now. Gold and silver performs as money, a store of value. Investors are waking up, and that will put the price or pull the price up. It'll be a bull market that won't end. Some pretty pronounced words from Steve St. Angelo. I tell you what, when he said that, it really made me think. I mean, as far as we continue to have some type of a monetary system that doesn't have a true backing to it, like gold or like silver, I think, this very well could happen, especially where we are at this stage in the game. We're headed towards some type of a transition into a new monetary system. And again, whether we do it quickly, slowly, whatever it is, we are going to transition. And this is where you definitely want to be hanging on to that gold and silver, or at least be buying some or understand what it's really about. The energy situation will destroy stocks, bonds, and real estate markets. And so those were his words. In a nutshell, the only way to protect yourself as assets are falling are in gold and silver. Selling metals for fiat at high prices is not a good idea. Metals will get stronger and stronger. And that's a question a lot of you guys have, or a lot of things that people talk about is what's your exit strategy from precious metals? Or you're going to sell your metals and go back into fiat. And the thing is, I think most people are not going to do that. I think it's the other way around because people are going to be looking for your metals and they're going to be offering you things for your metals. It could be a home, it could be a business, whatever it may be. And so I kind of see it as the opposite, where we're not going to sell our metals to go back into fiat. It's going to be people who are trying to get out of fiat and the real assets that they have, whether it's things like a home or a business, they're probably going to be coming to you with it, trying to trade it off for your gold and silver because they're going to be wanting your gold and silver. So the exit strategy, it's not about necessarily going back into fiat because you are going to have far, far, far more greater opportunities than just to go back into fiat. So another thing, Steve St. Angelo said.
At this price of in the 30s and $40, there's no way that they can really do much now. It's this oil price is gutting everybody. It's gutting the Saudis. It's gutting the UAE, Qatar. It's even hurting Russia because these prices, there's no real profit there. And so I think the idea that they're competing, they're trying to manipulate the price lower to get rid of the competition, I don't think that no longer matters because the energy return on investment of the oil continues to fall. And so there's not much profit there. And now with these prices, I don't see that as an issue. I really don't. So everybody's struggling at these prices. There's no real winners. I think it's going to be a lot more losers as we move forward.
Okay, so if we see more losers in oil, of course it means less oil companies. Would that then mean we're going to see another cartel the same way we saw OPEC? How would we then, or how would that then affect the fuel and oil price for miners, gold and silver miners? If we get a cartel who tries to raise the price of oil, that's going to raise the price of gold and silver as well. Prices at the petrol or gas station, how's it going to affect that? So really, what's the future of oil? What is the future of oil and energy? And I want to point something out that I think a good number of us did not hear about. There was a recently signed executive order hinting at the trouble future of oil and a shift. So there was this executive order that was signed, and I'll take you over to what it was. I first learned about it in an article from Zero Hedge. What happened was the U.S. takes a stake in battery metals miners to counter Chinese control. Let me go through this real quick, just a few parts. The U.S. government is taking a 25 million equity stake in Dublin-based battery metals miner TechMet as part of a push by President Donald Trump to reduce the country's reliance on supply chains dominated by China. The backing from the $60 billion U.S. International Development Finance Corporation will help TechMet develop, here we go, a nickel and cobalt mine in Brazil. I think some of you guys are familiar with nickel and cobalt. These are two key metals in lithium-ion batteries that power electric vehicles. So they're going to help TechMet develop a nickel and cobalt mine in Brazil. Both metals are key in the production of the batteries that power electric cars and cell phones. So there you go. TechMet's Brazilian nickel project. Let me close this. Hang on, where did we go? It was a project in the northeastern state of Piauí. Is estimated to hold as much as 72 million tons of nickel and cobalt. Investments in critical materials for advanced technology support development and advance U.S. foreign policies, is Adam Boehler, Chief Executive Officer of the government agency. It's what he said in his statement. The move follows last week's executive order declaring a state of emergency. You guys getting this? It's a declared state of emergency in the U.S. mining industry. Excuse me. The directive, which seeks pushing a local battery metals industry forward, also called for a report evaluating possible measures such as tariffs, quotas, and other trade restrictions, basically to even up the playing field. Okay, so this was pretty big news, and this came out ending September, beginning of October. Okay, and so naturally, who uses these metals? Tesla. So Tesla is now in talks with BHP. You can see the date here, October 6th. The executive order was, I think, September 29, October 1st, somewhere around there. So October 6th, this comes out. Tesla in talks with BHP over nickel supply pact. So Tesla knows nickel is going to be a very, very hot commodity. So they're in talks with BHP Group about a nickel supply deal as the electric car maker targets higher production and seeks to avoid a supply crunch because the U.S. is now calling it's a state of emergency as far as these metals go. So Tesla trying to avoid this crunch. And let me just move over to the nickel price chart so you can see what I'm talking about. And so here we go. So the date here, you can see is September 20, 28, 29, around there, September 30. And from this date, at about 14,200, it's basically come up quite a bit. It's come up almost $1,000 since that date of the announcing of that state of emergency executive order by Trump. So you can see nickel is on the move right now. And it is a metal that is going to be used very, very heavily in lithium-ion batteries for things like electric cars. So that one is pretty interesting. We need to keep an eye on that. Okay, so moving on, Jerome Powell, he spoke late last week to give an outlook on the economy, and so we're going to spend some time on what Jerome Powell had to say, because he always has some things that are very interesting to pick apart, and we're going to pick apart what he said. So having said that, let's pay particular attention to the coughs and the clearing of throats, and you see what I mean, because I think a lot of you have been noticing Jay Powell when he speaks. It's not so much that lavender tie anymore. He has a lot of coughs, and I mean, you kind of wonder, what's going on. He's saying something and coughing or whatever it is. Is he being honest with us? But anyway, let me just show you a few clips of what Jerome Powell had to say.
As the coronavirus spread across the globe, the U.S. economy was in its 128th month of expansion, the longest in our recorded history, and was generally in a strong position. Moderate growth continued at a slightly above trend pace. Labor market conditions were strong across a range of measures. The unemployment rate was running at 50-year lows. PCE inflation was running just below our 2% target. The economy did face longer-term challenges, as all economies do. Labor force participation among people in their prime working years had been trending down since the turn of the millennium, and productivity gains during the expansion were disappointing. Income and wealth disparities had been growing for several decades. As the expansion continued, its long run, however, productivity started to pick up. The labor market strengthened, and the benefits of growth began to be more widely shared. In particular, improved labor market conditions during the past few years encouraged more prime-age workers to rejoin or remain in the labor force. Mm-hmm. Meanwhile, real wage gains for all workers picked up, especially for those in lower-paying jobs. Most economic forecasters expected the expansion and its benefits to continue, and with good reason. There was no economy-threatening asset bubble to pop, and no unsustainable boom to bust. While non-financial business leverage appeared to be elevated, leverage in the household sector was moderate. The banking system was strong, with robust levels of capital and liquidity. The COVID-19 recession was unusual in that it was not triggered by a buildup of financial or economic imbalances. Instead, the pandemic shock was essentially a case of a natural disaster hitting a healthy economy.
Yeah, let it out, Jerome. You kind of get the feeling OJ there, he needs to let some of that bad stuff out every now and then. So let it out, Jay. Just let it out. All those fidgeting and coughs that seem to follow some controversial statements, it's really making the rest of us wonder about the if you're being truthful with us there, Jay. Anyway, Jay says regarding the pre-virus longest expansion of the economy, that was true. That was true. Generally in a strong position. To me, that's debatable because I don't feel we fully recovered from the 2008 crisis. And the reason I say that was because the markets were at about 7,000 then. It's almost at 30,000 now, 30,000 points now. And we've had help all along the way, or it's had help all along the way. QE1, QE2, QE3, all kinds of different programs. And then they tried to taper it off, and then it fell apart, and then they had to go ahead and then help it out again. So I'm not in full agreement with this. Generally in a strong position. I'm not in agreement with that at all. And then he talks about labor unemployment. That remains to be seen because a lot of these jobs are not coming back, as we know. Low inflation. It is low inflation, and the Fed is going to do everything they can to to bring that inflation on households that are already hurting. So I mean, again, you got to kind of wonder what truly is the motive behind all of these things. And he says the economy was doing great and expected to continue. By the numbers, that is true if you just look at it by the numbers. But if if you were to ask different sets of people, you were already seeing that wealth gap. It was already out there, already happening. So, Jay, he's sending mixed signals again, as he almost always does. He goes on to say there was no economy-threatening asset bubbles to pop. Are we going to believe this one? There was no economy-threatening asset bubbles to pop. Um, I'm not seeing that. I think all of us can see it. I don't know why they cannot see it unless they just choose to not be forthright and tell us. He also says no unsustainable boom to bust. And there is kind of truth in that, because as long as the Fed is going to keep helping out and intervening, it's not an unsustainable boom. It's a very sustainable boom. And that's exactly what we're seeing. But we're kind of running to the end of the road here as the virus kind of lifted the veil. And now we're really seeing things for what it's worth. He does say non-financial businesses leveraged elevated, meaning corporate took on a lot of debt. Banking was strong, robust levels of capital and liquidity. This was his words. He's going to know that better than any of us. And I think it's because he also knows if ever they do get in trouble, they are right there. They're the backstop. The bug recession, unusual. Yes. Not triggered by a buildup of financial or economic imbalances. The system was already sick. The system was already sick. So I don't really fully go with that as well. Natural disaster hitting a healthy economy. Again, if you just look at it by the numbers, yeah, he can absolutely say that it was a healthy economy by the numbers. But if you look at the reality, if you look at Wall Street and Main Street, no, there was a disconnect already, as we all know. So controversial statements, very, very controversial what Jay Powell had to say. Just want to go through one comment here. Let me see if I can pull this one up. New Mexico stacker mining industry news is very interesting. It is, especially with, like I say, electric cars are coming into play more and more, and we are seeing governments, pushing green deals. Whether or not you consider an electric car to be green or not, it's where they're going. Okay, that's the direction they are going, and part of where they're going, I mean, the things that are going to be picked up along the way, those metals, cobalt, nickel, especially nickel, and if ever you want, go back to our website www.silverbullion.com.sg. We do sell nickel, and this was something that we had seen coming. Gregerson, our founder, had seen coming quite a ways away, or quite a ways ago. So he even seen it coming. So if you're interested in nickel, go ahead and send us an email, and we'll help you out with that. So I'll move on to something else Jerome Powell had to say.
Given the condition of the economy, in the early stages of the crisis, it seemed plausible that, with a rapid, forceful, and sustained policy response, many sectors of the economy would be able to bounce back strongly once the virus was under control. That response would need to come from actions across all levels of government, from health and fiscal authorities, and from the Federal Reserve. It also seemed likely that the sectors most affected by the pandemic, those relying on extensive in-person contact, would face a long and difficult path to recovery. These sectors and people working in them would likely need targeted and sustained policy support. Some asked what the Fed could do to address what was essentially a medical emergency. We identified 3 ways that our tools could help limit the economic damage from the pandemic: providing stability and relief during the acute phase of the crisis when much of the economy was shut down, vigorously supporting the expansion when it came, and doing what we could to limit longer-run damage to the productive capacity of the economy.
Yeah, okay. I'll ease up on that already. But there we go again. I mean, Jay, he says controversial things, and here comes that cough, here comes that fidgeting, and again, the body language, it's really starting to make you wonder. So forget that lavender tie. I mean, we're seeing other things Jay Powell is doing that are really starting to make us question what's up. So anyway, maybe decades of Fed meddling is the reason we are where we are today, Jay. As your colleague Rosengren said, the decades of lower interest rates made people do very, very risky things. That mythical V-shaped recovery would need to come from actions across all levels of government. There's not going to be a V-shaped recovery. But the thing is, it's going to have to come from all levels of government, meaning the Fed, the Treasury, Congress. And the thing is, trying to get Congress to agree on anything right now, it's very, very difficult. So that V-shaped recovery it never had a chance unless there was agreement all across the board. It never really had a chance. Health, government, and the Fed need to be in lockstep. And this is, again, what we're talking about as far as if that V-shaped recovery, that myth were ever to really come, everyone had to be in lockstep. Targeted and sustained policy support. And again, that would go back to the Fed is choosing the winners and the losers right now. They are targeting their sustained policy support. Targeting, they're choosing. Provide stability and relief, support the expansion, and limit long-term damage. Basically means they're in it. They can't get out. They're trapped. They're stuck. And the only tool they have is that printer. That's it. They have nothing more. That's it. They're just trying to flood the market right now with anybody who needs some type of liquidity or credit. It's the only tool they have. In other words, print, QE until infinity, or until these new CBDCs are ready, the central bank digital currencies. So moving on, another thing Jay Powell had to say.
When it became clear in late February that the disease was spreading worldwide, financial markets were roiled by a global flight to cash. By the end of the month, many important markets were faltering, raising the threat of a financial crisis that could exacerbate the economic fallout of the pandemic. Widespread economic shutdowns began in March, and in the United States, with many sectors shut down or operating well below capacity, real GDP fell 31% in the second quarter on an annualized basis. Employers slashed payrolls by 22 million, with those on temporary layoff rising by 17 million. Broader measures of labor force conditions, such as labor force participation and those working part-time for economic reasons, showed further damage. In response, we deployed the full range of tools at our disposal, cutting rates to their effective lower bound, conducting unprecedented quantities of asset purchases, and establishing a range of emergency lending facilities to restore market function and support the flow of credit to households, businesses, and state and local governments. We also implemented targeted and temporary measures to allow banks to better support their customers.
All right, so there he goes again. According to Jay, once again, a global financial crisis was about to happen. Yeah, we we all kind of knew it, especially with Fed intervention all along the way from 2008. We went to zero QE and bought up everything along with the kitchen sink. Again, as I said, the Fed is throwing money everywhere, and it's not just within entities in the U.S. They've thrown money all over the place, even all across the globe, to keep that liquidity and credit going. Helicopter money, it's worked its way down to Main Street, and I there's really no foreseeable end right now, and they've supported banks, allowing them to support their customers. So in one way, he's saying, banks are robust and all of these things. And then in another way, he's saying you got to support the banks to allow them to support their customers. So in other words, they want the banks to give loans. Banks really aren't giving it. And on the other hand, people don't really want it. So again, Fed is they painted themselves in a corner right now. There's really no way out. And so why am I saying all these things? Again, it's just to kind of get the understanding that as much as the markets are showing that there's a disconnect between the markets and the real economy, there also seems to be a disconnect between, what policymakers are trying to tell us and where things really are. And that's the reason why we bring this forward to get you to understand that, you know, you got to take care of yourself. You need to do the things to take care of yourself, take care of your family. And on the other half of that, when you do that, you are going to have an abundance of opportunities and positive things that are going to come your way because you understood what was going on at this point in history, at this time in history. So, you know, again, I know a lot of the things I say are they're a big gloom and doom, but ultimately there is opportunity and positivity at the end of this. And that's why we want to talk about this, not necessarily in a negative light, but because you guys are going to be well positioned to come out ahead, generationally ahead. So we'll continue on. The Fed has created more zombie companies. Yes, they have. They bailed out banks. They stopped banks from selling off treasuries into the market. And this is because too high a supply of treasuries, meaning if you have more supply come in, the cost goes down. You have an oversupply, so the cost goes down. And what happens when the cost goes down, the interest rates go up. And the Fed cannot have rising interest rates, right? So Jerome says, no, 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 no. Give these treasuries to me. So let's take another look at something else Jay Powell had to say.
The fiscal response was truly extraordinary. The unanimous passage of the CARES Act and 3 other bills passed with broad support in March and April established wide-ranging programs that are expected to provide roughly $3 trillion in economic support overall. By far the largest and most innovative fiscal response to an economic crisis since the Great Depression. What have these policies managed to accomplish so far? First, the substantial fiscal aid has given vital support to households. The rise in transfers supported necessary spending and contributed to a sharp increase in household saving. Goods consumption is now above its pre-pandemic level. Services consumption remains low, although it seems likely that much of this weakness is the byproduct of health concerns and social distancing, rather than reductions in income and wealth. Consumption held up well through August, after the expiration of expanded unemployment insurance benefits, indicating that savings from transfer payments continue to support economic activity. A recent Fed survey showed that households in July had surprisingly upbeat views of their current financial well-being, with 77% of adults either doing okay or living comfortably, an improvement even over the reading immediately preceding the pandemic.
Okay, so a lot of fidgeting there again, Jay. Basically, PPP or helicopter money flew by just about every home, every business. Even dead companies and people received money. And I think we all saw the reports of that. When he says things like savings have gone up, you know, it's because people don't know when they're going to get more relief, so they have to hang on to what they have. It's not a positive thing that people are saving. It's saving out of fear, the way I see it. They don't know when they're going to get more relief. So, again, the numbers are there. It just depends how you want to read the numbers. So, by the numbers, Jay says people are saving money and most are doing well. Are you? That's my question to you. Are you doing? Are you doing better? More people are waking up and understanding that saving money means moving money out of the current monetary system and into alternative money stores of wealth like gold and silver. And we're seeing this, right? The Robin Hood guys throwing money in the markets thinking it's going to go up. We're seeing guys putting money in gold and silver trying to find that safe haven. We're seeing guys putting money in crypto, hoping that will increase whatever it is they have. There's a lot of fear. There's a lot of fear out there, and a lot of people are trying to find some type of safe haven asset that they can move into. Okay, so take another look at something else that Jay Powell had to say.
The pandemic is further widening divides in wealth and economic mobility. I'll turn now to the outlook. The recovery has progressed more quickly than generally expected, and the most recent projections by FOMC participants at our September meeting show the recovery continuing at a solid pace. The median participants saw unemployment declining to 4% and inflation reaching 2% by the end of 2023. Of course, the economy may perform better or worse than expected. The outlook remains highly uncertain, in part because it depends on controlling the spread and effects of the virus. There is a risk that the rapid initial gains from reopening may transition to a longer than expected slog back to full recovery as some segments struggle with the pandemic's continued fallout. The pace of economic improvement has moderated since the outside gains of May and June, as is evident in employment, income, and spending data. The increase in permanent job loss, as well as recent layoffs, are also notable. We should continue to do what we can to manage downside risks to the outlook. One such risk is that COVID-19 cases might again rise to levels that more significantly limit economic activity, not to mention the tragic effects on lives and well-being. Managing this risk as the expansion continues will require following medical experts' guidance, including using masks and social distancing measures.
All right, we got that again. I just wanted to thank Anamaxa here, super chat, appreciate it. Non-effective lower. it's been non-effective for quite some time already. That's a great comment there. It's a really good comment. But Jay Powell, he says the economy depends on the control of the spread of the virus. You cannot have a healthy economy without a healthy population. The wealth gap is widening. According to Jay, if you want that wealth gap to close, listen to the doctors. And less than a week after he says that, like I said, you can go ahead and look at it for yourself, where the WHO, the WHO, World Health Organization, says that lockdowns are probably not the best thing to be doing. And so, like I said, it keeps changing. Do this, everybody to the left. Do this, everybody to the right. It's confusing for people, and again, people, they're out of work. They're trying to make ends meet. People who have done well, they see that instability coming down the road. They're trying to find stores of wealth. It's crazy time. It's a crazy time right now. Other things he said, governments and doctors, again, as I was just saying, sorry about that, they cannot agree. Therefore, how are we going to agree? How are we going to agree? Your government can't agree. Medical professionals can't agree. How are we going to agree? Again, this just shows the instability in things. Putting all aside, this instability, it's going to continue. And for nations around the world using U.S. dollars, they're going to speed up to get away from that U.S. dollar. Because, like I say, when they look at the population, it's in chaos right now. People can't seem to agree on anything. They look at the government. It's in chaos right now. It can't seem to agree on anything. And they know elections are coming up. And it may be a bit more trying once those elections are done, because I don't think any side is going to be happy. And so if you're outside, in the world and you're looking at things, you realize maybe holding dollars might not be the best thing. you know, maybe I should put it in, again, a store of wealth, some type of safe haven asset. This is what the world is seeing. I just showed you where they're even moving off of the dollar. And so, you know, if you're in the States, you know, you probably won't deal with the foreign currency. So you probably don't see these things. But that's where you can go ahead and, again, get things like gold and silver on the true alternative currency, the true money, the true sound money. So the last people who are going to know that no one wants the US dollar are, to be frank, it's going to be the people in the US. Because as I said, they don't trade into a different currency. They stay in that US dollar. So they're not going to see it. If you're in the US, you're not going to see it. But everything else out here is pointing in that absolute direction that it is time to really start moving outside of that dollar, have things outside of the dollar. And again, gold and silver, I said this before, it's a hard asset that is very, very liquid. I mean, if you go into it and you see, you know what, I don't believe it. I think the world is fine. You can come back out of it. It's that liquid. If things really, the dollar takes a hit, things do go a bit bad, that's your insurance. So it's both an investment and an insurance. You know, that's just the way I look at it. It's the way a lot of people, it's the way a lot of people look at it. So it is a good thing to start looking at alternative currencies, not maybe in the crypto sense, but in the sound money sense. Okay, so another thing Jay Powell had to say. Having fun with Jay today, huh?
Still, since it appears that many will undergo extended periods of unemployment, there is likely to be a need for further support. Second, aid to firms, in particular the Paycheck Protection Program, and the general boost to aggregate demand have so far partly forestalled an expected wave of bankruptcies and lessened to permanent layoffs. Business investment appears to be on a renewed upward trajectory, and new business formation similarly appears to be rebounding, pointing to some confidence in the path ahead. Third, after briefly seizing up in March, financial markets have largely returned to normal functioning, albeit in the context of extensive ongoing policy support. Financial conditions are highly accommodative, and credit is available on reasonable terms for many, though not all, households and businesses. Interest-sensitive spending has been relatively strong, as shown in the housing and auto sectors. Taken together, fiscal and monetary policy actions have so far supported a strong but incomplete recovery in demand and have, for now, substantially muted the normal recessionary dynamics that occur in a downturn.
So there we go. There we go again. I'm going to pull up a comment here first. Bloodbath McGrath. At this point, the citizens of countries are the ultimate currency because we determine the taxes. We determine the taxes that the countries and governments make off of us that they spend on all their stuff. That's a pretty interesting point. People are the currency. It's a pretty interesting point. So let me get back to what Jay Powell was saying. So according to him, more help, more stimulus. We're not done. We're not done yet. We are going to print until that the bearings fall off the machine, smoking, can't fix, can't repair it. They're going to keep it going. It's not going to stop. They're going to choose more winners and losers. It's going to continue. Zombie companies will be kept afloat. That's going to continue. They're going to, again, pick who they want to see transition over into, you know, this new monetary system. Once we come out of it, you know, they're picking winners and losers right now. People buying homes and cars, credit, they're taking on. They want them to take on debt, is what I should say. So they're trying to make it easier for people to go ahead and spend money on things. They want you to take on more debt, and they need your help because if you take on debt, then that helps them to get the velocity of money and the inflation that they need. So yes, the Fed is going to help you. They are trying to get that inflation. So a few more things that Jay Powell said.
Expansion is still far from complete. At this early stage, I would argue that the risks of policy intervention are still asymmetric. Too little support would lead to a weak recovery, creating unnecessary hardship for households and businesses. Over time, household insolvencies and business bankruptcies would rise, harming the productive capacity of the economy and holding back wage growth. By contrast, the risks of overdoing it seem, for now, to be smaller. Even if policy actions ultimately prove to be greater than needed, they will not go to waste. The recovery will be stronger and move faster if monetary policy and fiscal policy continue to work side by side to provide support to the economy until it is clearly out of the woods.
Okay, so that was Jay talking about the fiscal monetary policy and some things he said. The Fed is saying monetary policy cannot work without support from fiscal policy. In other words, they only can do so much. They are limited with what they can do legally, and they need Congress to approve or give them the approval to go ahead and do other things. So, again, trying to get everyone in lockstep on this thing is almost an impossibility right now. And it's almost like if they do, everyone does get in lockstep, then it's almost like you're nearing the end of the game at that point where there's no choice except to go ahead and let things run through. So again, it does feel like things are getting a little bit closer here. Central banks are saying they are gonna have that new digital currency for us. And so it does look like we're moving pretty quick now. And it's again all the more important you understand having things outside of the financial system. So let me play one last clip from Jay Powell.
The recent changes to our consensus statement reflect our evolving understanding of several important developments. There has been a decline in estimates of the potential or longer-run growth rate of the economy and in the general level of interest rates, presenting challenges for the ability of monetary policy to respond to a downturn. On a more positive note, we have seen that the economy can sustain historically high levels of employment, bringing significant societal benefits and without causing a troubling rise in inflation. The new consensus statement acknowledges these developments and makes appropriate changes in our monetary policy framework to position the FOMC to best achieve its statutory goals. The forward rate guidance adopted at our September meeting reflects our new consensus statement. The new guidance says that with inflation running persistently below our longer-run 2% goal, the committee will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. The committee expects to maintain an accommodative stance of policy until these outcomes are achieved. The committee also left the target range for the federal funds rate unchanged at 0 to 0.25%, and it expects it will be appropriate to maintain this target range until labor market conditions have reached levels that are consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. We expect that the new framework and guidance will support our efforts in pursuit of a strong economic recovery.
Okay, so they wanted to get above that 2% for some time. Declining growth rate of the economy, no V recovery. There's just no V recovery. Can't raise interest rates. This will be a challenge not to go negative. We can employ many and inject money into the system without seeing inflation. They've learned that. They've learned that. And he says we won't raise rates anytime soon. Won't raise rates anytime soon. Again, you can either look at it as, they're going to stay in the markets and intervene. So go ahead and take it while you can. Or you can see it as they really are in trouble where they don't see any way out right now. I should be going into safe haven asset, and it's up to you. Either you're the gambler or you're the conservative. It's up to you which way you want to go. But it may be a good time if you have made some, maybe take some off the table and start putting into safe haven assets. So it's really a lot of mixed messages. He's trying to stay right down the middle, but as he's doing that, he's not giving anyone too much confidence in anything that he's saying. We understand what he's saying, but there's still the other side of the coin. We're all trying to find some confidence in his words. So he says we won't raise rates anytime soon, and we are going to give you inflation for some time. And it's not an exact quote, but that's the gist of what he's saying. We're going to get that inflation, and we're going to give it, or we're going to give it to you, and we're going to keep it above that 2% for some time, because we have to make up for all this time that we couldn't get that 2% target. So we're going to try and average it out to 2%. So expect it. Expect the inflation. We saw Drunken Miller saying, it's a raging mania right now. He expects it. Um, the gentleman after him, he expects it also. The clip that I showed after Drunken Miller, he expects it also. And um, you're going to hear it come out more and more. I think you are going to be hearing people talk more and more about inflation. So with that, if anyone paid a fraction of a second to the markets, they would know it was in trouble. Last year, we saw the repo market crack 1 year ago, September 2019, right? Late September, we saw it crack. So if we're paying attention, we saw it in trouble last year before the bug. Or we can go back to 2018, where we saw the Fed having to cut rates. Go back to 2017, where the markets tanked after just reaching a 2.25, 2.5 Fed funds rate. So we saw it in trouble all the way back then. Or we can go back to where tapering was tried and failed. We can go back to QE3, QE2, QE1, to the crisis of 2008, where I mentioned earlier the Dow was at about roughly, 7,000 points. So how did we get from Dow 7,000 to Dow just under 30,000 in a decade? Was this true economic growth? Was it a true recovery? And we had Rosengren say, those decades of low interest rates, it's going to hurt us. It's going to hurt more than help. So even the Fed, they're mixed. They're sending mixed signals. Governments are sending mixed signals. And we got to kind of read through it. We got to kind of read through it and understand what we need to do. So here we are because of Fed intervention, not because of true market forces, not because of true capitalism, not because of true supply and demand. None of those. We're here because of a 1913 charter creating the Federal Reserve with a mandate of maximum employment and price stability, two things that sort of contradict each other, where the Fed is always going to have to keep their hands on the throttle to move it back and forth. We're here in large part because of that. It's a mandate that contradicts itself, an impossibility without fail, combined with politicians who carry no responsibility, waving a "We the People" bank credit card. Spend now, pay later. Tax future generations. Tax future generations. That's basically all countries. Taxing future generations. And then you understand why we are where we are today. This isn't anything political or anything like that. This is just to say this is the type of monetary system that we are in. And it lends itself to where a politician would choose not to be responsible. And, their goal is probably re-election. And if they keep taxing you, they're not going to get re-elected. So they want to kick the can. They want to kick that can down the road. So understand three things. Again, this is not just a U.S. matter. This is something that's going to affect the whole globe. But there are positive and life-changing opportunities that are going to come to you if you understand what you need to do. I see some guys mention food. I see, other people mention other things. All of those things are important, not to say, any type of Mad Max things or something like that. It's just to say that you got to do what you can to protect yourself and your family. And some of that is understanding money. And granted, it's not an easy thing to understand. I mean, how long did it take each of us to really understand what the Federal Reserve is? How long did it take each of us to understand that since 1913, our dollar has lost about 96, 97% of its purchasing power? How long did it take all of us to understand what inflation is when there's too much money chasing after too few products, too few supplies? How long did it take us to understand? You can easily go back and look at home prices since 71. And I showed a chart on this a while back. Once we went off that gold standard, you've seen home prices just rise phenomenally. I mean, you think Bitcoin rose, you take a look at home prices since 71, how much they've gone up. Like I said, my parents' home. They bought that home in 71, I believe, for 17,000. No real change. The lot is still the same size. The house is still just about the same size, but it's their home is valued at about 400,000 now, and nothing's changed. Nothing has changed. If anything, the house has gotten older. So there you go. This is what money printing has done. This is what going off the gold standard has done. And the thing is, how long did it take for us to understand this? And if it took us quite a while to understand, you can't imagine how long it's going to take our family, friends, and neighbors to understand. Um, it's not an easy thing to explain, but it's something that we all need to try and understand. And as I say, we gotta try and be that blessing, not that burden, because a lot of people they're gonna end up unfortunately being a burden. So we have to do what we can so we don't end up being a burden on someone else, where we are a blessing for our friends and family. So we have to try and keep that in mind. Jeff 702, $100 silver. Let's go. Maybe not yet. I need to get some more. I'm pretty sure a lot of you guys need to get some more too. But yeah, that it will come. I'm pretty sure that day will come. See what other comments are out there. Let's see if I can find a few more comments before I head out. Let's see, Butchie Harding, saving in coin is the only way for people to get ahead. I'd agree with that. In a sense that we need to get into real hard assets, something that has value, behind it. And again, which is why these central bank digital currencies, it can be, I mean, I'll say there is some good in it, but there is also some bad in it. So I mean, it's something we'll see how that plays out. Let me take a look at a few more comments here. Let's see. You will only buy what they allow you to buy. That's the purpose of digital dollar. That's a rough one. That's a rough one. But I mean, you can kind of see. I guess you could kind of see. Let's say, for guys out there with health issues, like let's say diabetes or something, can't be having these sugary sweets, right? So let's say if you have that digital dollar, I mean, sure, you can see where you walk over into a 7-Eleven and you try to buy some kind of a snack, chocolate or something, and the clerk takes your card or whatever it is that you have, and he's going to tell you, sorry, sir, you're not allowed to have these things. And why? Because maybe some lobbyists from health insurance went ahead and told Congress, look, we're paying too much in healthcare for people, so we have to limit what they can have, or not allow them to have things. So there you go. A bill is passed where maybe you can't have certain types of things. So, I mean, I can see that in that sense where, you say, you may not be able to get some things. Now, some people might say that's good because you shouldn't have it anyway. Some people might say, hey, but still, I should have the freedom to buy what I want. It's always two sides of the coin. It's always two sides. So, we'll see how it goes, but just stay on top of things. You got to stay on top of things. So I guess always be funding. Yeah, I'll take that one. Where we at 173. I'll take that, and I do appreciate it. It really does help us out. So one more thing, if you're still here, Xiong, if you're still here, can you type something in the comments, because we need to get your email. So Xiong, we're looking for you because you got that you got the correct word. We were looking for energy. So if you're still there, please comment to us, and we'll try and get your email. Let's see what else is out there. I'll give Xiong a couple more minutes, see if he responds, so we can go ahead and get him that book. Let's see. James, the Ponderer. Everything up until now is preparing all of us for what's coming. James, that's a good point. If you've been paying attention and you understand things, and I think most importantly is if we still have that ability, or if you still have that ability to see two sides, to somehow be a bit moderate, where you can understand things on this side, you can understand things on that side, and you take the best of it all, and you draw your own conclusion, then I think for sure it's prepared you to understand, because otherwise you it's very easy to dismiss the way things are today. It's very easy to dismiss good information that could have helped you just because maybe you didn't agree with it or want to hear it. And I think that's probably one thing that'll hurt more than help. So we got to take the good medicine, we got to take that bad medicine, and then try and get better from hearing two sides. That's what we need to do, is to hear two sides. So let's see. Hey, Froman, that chocolate eater drives up your insurance cost. Yeah, that's my fault. I'm driving up the insurance cost. I'm a chocolate eater. Okay, Xiang, I don't see you here. We'll try somehow. I don't know if we can try and get back to you, but maybe if you could get to us somehow, some way, if you ever watch this again, replay or whatever it is, just let us know, because we're trying to find you so we can get your email. Um, okay, so let's see. Fat Vegan, this will be the last comment. Per 1965 quarter is now worth over $5. And this is something that I talked about. There you go, save that silver. This is something I've talked about before, where if you take 3 of those quarters, or I should say six of those quarters in weight are about no, hang on. I'm thinking half dollars. If you take 3 of the half dollars by weight, you have a little bit over an ounce of pure silver once you calculate it with the 90%. And today's price is about $24 or so. And so what I'm saying is, if you had kept that silver in that coin, which is again 3 half dollars, which is $1.50 in face value, $1.50 in coin, with that silver content is about $24 today, which surpasses that $15 minimum wage that people want. So had they kept that silver in the coin, $1.50, 3 half dollar coins, which weighs a little bit more than an ounce, comes out to more than just that. That comes out to more than that $15 minimum wage people want. And it's a pretty good example where how silver, it moves and it fights off inflation. So, had they left that metal in the coin, kept it metal money, we'd probably be okay. So anyway, with that, I appreciate you guys being here again. Be that blessing, not that burden. Keep your nose in the news, but take some time to relax and enjoy things. There are going to be opportunities out there, and we'll see you again next week. As always, saddle up for what's coming ahead and silver up. You guys take care.